Good afternoon, everyone. Welcome to our webinar today on Cambodian tax compliance. To start with, just a bit of an introduction to Acclaim. As many of you know, Acclaim Cambodia is a leading provider of professional corporate services, delivering international standards of accounting, tax, HR, payroll, company secretarial and advisory services to businesses operating in Cambodia. As part of the Acclaim Group, which is an Asia-focused corporate services specialist with a strong on-the-ground presence across the region, Acclaim Cambodia combines deep local expertise with seamless regional capabilities. The Acclaim Group was built to support companies in navigating Asia's most complex and fast-evolving markets, with a particular focus on emerging economies, where regulatory and administrative challenges require hands-on, proactive, practical solutions. Acclaim Cambodia reflects this philosophy by offering responsive service underpinned by robust governance, technology, and compliance standards. We have a team of experienced local professionals here and also access to Acclaim's regional network. We support clients through their entire business lifecycle, from market entry and company formation to ongoing compliance, expansion, and cross-border operations. By staying ahead of regulatory change and maintaining close relationships with local authorities, Acclaim Cambodia enables clients to operate efficiently, remain compliant, and focus on long-term growth in Cambodia and across Asia. Today, we have our Head of Tax in Cambodia, Seng Pao, to answer questions around the Cambodian tax system and the compliance obligations of companies registered in Cambodia. I hope you find the session informative. Now, to start, I'll ask Pao to quickly introduce himself before we move into the questions.
Okay, good afternoon, everyone. My name is Pao. In Khmer language, Pao means the younger child in the family. However, in the office, it's quite the opposite, exclusive. Anyways, I have been working in this tech profession almost 18 years, covering a broad range of areas, including tech compliance, tech consulting services, and tech audit assistance. It is a pleasure for me to have the opportunity to share with you some of my practical experience and observation with you today. I hope it will help you to access your tech compliance position, as well as to identify any potential tech link you may have on your business operations. If you have any question, as my team just said, you can drop them in the chat box, Q&A. Then we try to address it accordingly. However, from my experience for this kind of session, sometimes you don't have enough time to respond to the question. If it is the case, I will try to respond to you separately later after the session. So I think we can dive into the topic.
Okay, thanks, Pao. So the first area we want to cover is where international businesses often misjudge Cambodian tax obligations. And the first question I have for Pao is, can you please outline the general tax obligations of registered taxpayers in Cambodia?
Okay, Cambodia, we follow the real regime taxpayer, so meaning the self-declaration. It seems that sometimes it's quite confusing that we already file and pay everything, but still we may have a potential tax in the future because we under self-assessment, meaning that after you already file all the required tax return, you are subject to a further tax audit in order to confirm whether you have any further tax liability or not. So after your registration, you are required to comply both monthly and annual tax compliance. Monthly tax compliance generally includes prepayment of profit tax on your income at the rate of 1%, while you add the tax on your turnover as well at the rate of 10%. Tax on the salary that you provide to staff at a progressive tax rate from 0 to 20% for the resident employee, and at the flat rate of 20% for non-resident employee. In addition to that, there may be some other benefit that you may provide to staff or management team, like accommodations, traveling, for example. This kind of benefit also subject to 20% fringe benefit tax. In addition to that, certain expense may be applicable to the withholding tax. Withholding tax in Cambodia include various rates from, for example, 10% on the rental, 15% on the service provided by non-registered company, and 40% from the management technical service, for example, provided from the non-resident taxpayer. Lastly, it's about the annual tax compliance. It's quite straightforward in Cambodia. Most of the company are subject to the normal or standard corporate income tax at 20% on your profits. Lastly, it's about patong tax. Normally, patong tax payable, it depends on your taxpayer classifications. The small taxpayer will be subject to just $100 per year. For the medium is $300, and the light taxpayer is 350. So failure to comply with this tax obligation, you will be subject to penalty. And the penalty include 10% to 40% for the additional tax, plus 1%, 1.5% accrued interest per month, which is quite a lot. Yeah.
Okay, thanks. And when foreign companies come into Cambodia, they often have experience with their tax regimes in their own country, but obviously not in Cambodia. What are some of the most common incorrect assumptions that foreign companies make when coming into Cambodia?
Yeah, I have one common question that asked most of the time. I mean, when they're making loss, why they are supposed to pay a corporate income tax? So during the preparation of the first year tax return, or we call corporate income tax returns for the newly established entities. So I frequently asked by the company why the company would be subject to pay tax even when they're making loss. So from a corporate tax perspective, when a company in the long position, generally, it should not have any corporate income tax payable. But in Cambodia, you are required to pay 1% minimum tax, even though you are making loss. So this rule, it's appear inconsistent if you compare to the other country. So maybe from 2017 onwards, there's a lot of complaint from the private sector saying that it is not fair. I'm making loss, then I still have to pay tax. Then the Ministry of Economy and Finance decide to exempt the 1% minimum tax, but with a condition: if you are considered a company that have proper accounting record, then you will be exempt from minimum tax when you are making loss. But if you did not get the approval from the GDT, you still applicable to the 1% minimum tax. The second assumption is 1% prepayment of profit tax that you pay every month. Some foreign entity may consider it is the additional tax burden or obligation that they have to fulfill. Actually, it is not. It is the advance tax on corporate income tax. It seems that the GDT borrow money from the company, then it is your tax credit, meaning that you can use that to offset with your annual corporate income tax at the year. So basically, it is not the additional tax obligation, but it is just advance on your corporate income tax. One assumption is about overpaid tax. The taxpayer, when they paid over, let's say they overpaid tax based on the technical error. So basically, they should be able to refund that in cash back. But unfortunately, in Cambodia, yes, you still refund, but it is a time and consuming process. So based on our experience, it is suggest that we request as a tax credit on the overpaid tax paid to offset the other tax payable. It is the three common assumptions if you compare to the other country. Yeah.
And so when you, just to follow on with that, when you apply for a tax credit, does that mean that credit is offset against future tax you pay, say in the following financial year?
If we are talking about the overpaid on a monthly tax, for example, you can use that to offset with your monthly tax payable as well.
Okay. And the concept of permanent establishment is is present in many tax jurisdictions around the world. What sort of things trigger a permanent establishment here in Cambodia, where the company is not necessarily operating here, but might have one or two people on the ground performing, say, marketing service sort of thing? What do they need to be careful of to ensure they don't trigger a permanent establishment assessment?
Okay, permanent establishment is considered quite new for Cambodia. Actually, this regulation is this rule in the regulation for quite a long time, but it seems there is no enforcement from the GDT. But recently, it is the case. So PE from a Cambodia context is a fixed place of business or a resident agent through which the non-resident carrying out the business. So it mainly includes, for example, the office of the management team, the warehouse, the workshop, the factory, for example. If you do this kind of thing in Cambodia, it's considered to have PE. When you have a PE, the non-resident person will be subject to the corporate income tax at 20% on your Cambodia source of income. So the activity that the non-resident person may overlook or not realize that when they have this kind of activity that will create a PE. Let's say sometimes they send their staff to work in Cambodia multiple times within a single year. So they will get to count how many days the staff will stay in Cambodia. So if we add up this multiple times together, if the duration is more than 183 days, then their non-resident person considered to have PE in Cambodia. One more thing is that you have a person that have the power to or authority to conclude a contract on behalf of the non-resident persons. Then you have a PE as well. So these two common things that you try to avoid in order to not have PE in Cambodia. But what very interesting is about rep office. Recently, the GDT target PE exposure on the rep office by considering that that rep office is acting as the facilitator between the head office and the buyer in Cambodia. Then the rep office that have operation more than 5 years, maybe in the list of the target that the GDT try to attack. So if you have rep office in Cambodia under situation, I would suggest that you review your current structure and take necessary action to avoid any potential risks from the attack. Yeah.
Okay, thank you. And with companies in Cambodia that have head offices or regional offices overseas, and let's say the regional office charges the Cambodia company for management charges that have been that relate to the time that someone offshore spends managing the company in Cambodia. How are those charges treated in Cambodia?
Okay, hot issue as well. Okay, intra-group charge are considered as related party transaction. And the view from the GDT, I believe in the other jurisdiction as well, they may consider it is the tax planning tool that the taxpayer may use in order to minimize their tax burdens. So it is the view from the GDT, I believe, I said, in the other tax jurisdiction in the same view. So to minimize that, we suggest that the rates that they use should be an arm's length. Arm's length may refer to the amount that will be charged between the non-related party under comparable transaction or circumstances. Let's say, for example, under the same condition, if we buy a bottle of $1, and then the other should charge $1 as well. The different condition, let's say, when I buy a bottle, but I not pay in cash, it is in account receivable, for example. It is considered as different circumstances. So the rest should be different as well. So when you buy on credit, the fee charge may be sometimes higher than when you pay in cash. It is the different is simple different that we consider about arm's length. Okay, based on my experience, the tax auditor will try to check or review on the rate that you use, even though you have the TP report. And if it is the case, we need a lot of time or substantial explanation in order to overcome these questions. But based on my experience, as long as you have the TP report, we cover all the required conditions based on the TP regulation. We can conclude that you are compliant with this requirement and it's safe to have the reassessment on your rate chart within your related party transactions.
Okay, and just following on from that, head officers will often also lend money to a local Cambodian company, and sometimes they'd like to lend the money at zero interest rate. Is that possible? Does the Cambodian tax authorities accept a zero interest rate loan? And if so, what sort of conditions or requirements are there that the Cambodian company needs to comply with?
Yes, there is a special exemption under the TP regulations that it excludes the interest-free loan or related party loan, meaning that interest-free loan is acceptable by the GDT, providing that you have prepared proper supporting document required by them. You have loan agreement which clearly specify the date of repayment of the loan. You have the business plan, but this business plan is seem a broad definition. So the GDT disclose another alternatives that you can have financial projections which show that how loan will be used. Then it's also acceptable as a replacement for the business plan. And for the company that have more than 2 shareholders, for example, you are required to have a board resolution to decide on that loan as well. So if you meet these 3 conditions, interest-free loan is acceptable.
Okay, thank you. Now there are some tax incentives that are available to investors in Cambodia, generally under the QIP regime. Could you please sort of outline in a little bit more detail what requirements a company would need to satisfy to be eligible for tax incentives under a QIP?
So under QIPs, it is not applicable to all company. There is a certain company that eligible for that scheme. Let's say a government, a hotel that have more than 100 room, for example, a hospital that have more than 100 room or a bed, for example. This kind of company is considered an investment company, and then they can apply for the qualified investment project from the CDC. Then you are eligible for certain tax incentive.
And those tax incentives include exemption from income tax for a period and VAT exemptions? Any other exemptions?
Yes, the tax incentive cover what is the QIP mainly focus is not really about the corporate income tax sometimes, but it's about the exemption on the custom duty when they import the good from overseas or import the raw material as well as the machinery for their production. Yes, the main exemption is compared to the other exemption. In addition to that, they're also eligible for the corporate income tax up to 9 years. So it depends whether they're under class 1, 2, or 3. Class 1, for example, 3 years, class 2, 6 years, and class 3 is 9 years. So it depends on their classification of the group as well.
Okay, thank you. We've just got a few questions that have come in on this the subject of the subjects we've just been discussing. So I think we could probably look at those, see if we can answer those. If you have different promotion scenarios to specific customers, so you allow different discounts to different customers, is that allowed under the tax system, or will the GDT say you should be charging the same rate to all customers?
Yes, it is quite subjective topic. Previously, there is no clarification from the GDT how a tax treatment should be considered for this kind of transaction. But I believe maybe last year, the GDT issued a clarification on that. If you provide a discount to general customer, meaning that all the customers are eligible for their discount scheme, then it is not subject to any tax on the discount. But if you provide that discount to a specific group, like you just mentioned, we have a different discount scheme to a specific group. then that discount is subject to the VAT.
Okay, thank you. And a question on VAT. Is there a turnover threshold where you do not need to register for VAT? And if companies, I understand when companies are registered, when a company is registered, they're automatically registered for VAT. A sole proprietorship would only be registered for VAT, I think, when the turnover reaches a certain level. Is that right?
Yes, you are correct. But as you just mentioned, it is automatically issued when you register a new company with the GDT. It automatically register for VAT as well.
Yeah, and for a sole proprietorship, there's a threshold of sales before you have to register for VAT.
I said it apply in the same, but for sole proprietorship, you are required to register or not. It depends on your threshold, but not VAT. But for the company as a whole, let's say if you does not meet the threshold for registration, then you are opt not to register. But if you are a company or rep office, for example, it is compulsory that you have to register regardless whether you have a turnover or not.
Okay. Okay. And a question here, which I think even I think I can answer this one. If you've got accounting compliance and certificate, do you still have to pay monthly prepaid tax, even though there's been a loss in the past year and the current year? Or do you get an exemption from minimum tax because you have the gold certificate?
I cannot hear you. It seems that the connection was cut off.
Yeah, sorry, I'm back again. If you have a gold certificate, do you, even though you're exempt from minimum tax, do you have to pay the monthly prepayment of tax?
Yep, you are still required to pay 1% repayment of profit tax, except the QIP during a tax holiday period. You are not required to pay 1% minimum tax, 1% repayment of profit tax.
And so then at the end of that year, if you are in a loss and you have a gold certificate, you can get a refund of the minimum tax you've paid. Is that right?
Not right. Currently, we most of the taxpayer confused about gold certificate and the approval for recognition as proper accounting record enterprise. So gold certificate have a certain incentive, but in order to exempt from minimum tax, as long as you get the approval from a GDT that you are considered as the company that have proper accounting record enterprise. Otherwise, it is not exempt from minimum tax. So suppose that you have that approval, then the 1% that you pay every month can be claimed as a tax credit. Yes, basically you can request for refund, but I said it's a time-consuming process. Then you can use that to offset with your new year prepayment of profit tax.
Okay, thanks. Now I think we move on to the next part of the webinar, which is common tax filing mistakes and how audits are triggered as a result. What are the most common mistakes made by companies when filing their tax returns?
Okay, not many because I have never noticed that, but I have a few for you. So the duplicate entry in the purchase record. I mean, for example, in the withhold tax regulation, you are required to pay withholding tax the early of the transaction accrual or the early of the payment. So sometimes you have not yet received the invoice, but based on the withhold tax regulation, you are required to declare withholding tax based on the accrual basis. So in order to facilitate the withholding tax declaration, you're supposed to include that transaction in the purchase record. So later on, when you receive the invoice, some company will also declare that invoice in the purchase record. So you see one transaction, but we record it in the purchase record 2 times. There is the common errors that some company may have incurred already, but technically you are not supposed to record that invoice again because the invoice not yet received, but you already disclosed the amount that you already accrue in your accounting books. There is the common error. The second error is about the VAT input claim, meaning, for example, for the ERT kit invoice, there is the combination of both taxable and non-taxable supply, meaning that the company that said the ERT kit just charge the VAT on their commission or service charge. So the ERT kit value will not subject to 10% VAT. But when the company claim, they may forget about this taxable and non-taxable amount. They just use the total amount and divide it by 1.1 to claim the VAT, which is not correct. The second thing is about the international transport invoice. Let's say there is some item which is subject to 0% VAT and some subject to 10% VAT, similar to the air ticket invoice that some company may claim 10% VAT on the total amount, which is not correct. There is the common things that we see a lot of taxpayer incorrectly have in their tax return value.
Okay, thanks. And in terms of late filings and inconsistent numbers across multiple monthly tax returns, does that generally lead the tax authorities to look more closely at the company with a view to triggering an audit?
Yeah, absolutely. So let's say, for example, when you declare the income in your monthly tax declaration, which is higher or lower than your annual income, for example, then it is the factor that the GDT may conduct an audit.
Okay, thanks. And how does the GDT normally look at companies and choose companies to audit? Is it triggered by e-filing? Although most companies do e-file these days, so probably not. But what is it triggered by? The amount of turnover of the company, the reported profit of the company? What's been your experience in what you see as being triggers for tax audits on clients?
Yes, it is the combination of most of those that you just mentioned. So e-filing play an important role for the GDT now, because from the information in the e-filing, GDT can easily identify the inconsistency as well as the unusual pattern of a taxpayer. Then there is the factor that conduct an audit as well. One more thing is about the amendment of tax return. Some company, if they have a lot of amendment of tax return for the year, for example, so the GDT will use that there may be something error that they should conduct an audit to verify that. Last thing is about the physical side and what the company have been declared. For example, the company physical side is very big, but the amount that you declare to the GDT is very low. Then it is the risk approach that the GDT will assess whether to conduct an audit or not.
When you assist companies with audits, where do you see the main documentation weaknesses arising? Often the GDT will ask for documentary evidence of expenses and invoices, etc. Where do companies generally fall down in keeping those types of records?
Yes, based on my experience, the document weakness is about we call local market. When we buy goods or something from the local market, that invoice does not disclose the full identification of the supplier, then the GT will not allow that as an expense. And one more thing is about the import. Some company import goods which is belong to them, but they use the logistic company name sometimes. So there is it create this allow expense for them. The company have a ground to reject that good is not belong to you because you don't have the import document to support that you import that goods.
And so does the GDT then disallow that expense because you don't have the correct documentation?
Yes, you are right. For the local market, based on my experience, yes, they will not allow that expense because you don't have any proof that this supplier does exist. But for the import transaction that I just mentioned, we can approve for them to allow the expense by providing, let's say, the payment to the vendor at overseas, the audit report, for example, that the independent auditor does agree on their documentation as well. And we have the invoice from the vendor from overseas as well. This can consider as the actual expense, but we don't have the import document. Then it can prove that it is considered as allowable expense. That case we already explained, and the GDT agree on that.
And does it assist the arguments of the taxpayer to have bank records supporting all of the inflows and outflows that appear in the tax return?
That is a must. But actually, most of company cannot have all the transactions through bank account because the big ticket, for example, right? So it will not through the bank account. So beside that, it is recommended that all the transactions should be through the bank account.
Okay, thanks. So that's the end of the questions on common filing mistakes. Sorry, that just a few questions have come in. So how often does the tax department carry out audits on companies?
Before we can say every year, but currently the SOP for tax audit have been changed, meaning that they can conduct side audit for every 3 years. Let's say, for example, 2026, there is a limit audit count. So 2026, 27, and 28, there will not be any side audit count.
Okay. And if an overseas director from the group visits a local business in Cambodia, are expenses incurred by that overseas director tax deductible?
If that director come to, let's say, provide the strategic planning or discussion with the company transaction or operation, then it is allowed for deduction. But there's required to have proper document. Let's say you have the agreement with it come to the intra-group charge. There is a proper document that together with the invoice charge for that particular transaction. Then you can claim it as a deduction in Cambodia.
Okay, thanks. So let's just move on to the third topic that we cover today, which is what does good ongoing tax compliance look like in Cambodia? So in your experience, what are the taxes that require the most frequent monitoring in the day-to-day business operations of a company?
To me, it is not limited to a specific type of tax. All tax to be properly monitored. However, the more critical factor is about the size of the transaction. Let's say, for example, the service company like us, a client. So the tax that we should closely control is about tax on salary and the VAT. And for the restaurant or hotel, for example, the type of tax that should require is about the discount scheme, for example, that you have to consider whether you have applied proper tax on that discount scheme or not, the issuance of the invoice, whether the invoice issued properly or not. We experience a lot that the restaurant and hotel have not yet complied with the invoice issue requirements. For example, manufacturing, whether we have proper supporting document to support the processing from raw material to the finished good or not. Because during tax audit, the GDT will consider recalculate based on your formula of the production, whether it's aligned or not. If not, that we consider to disallow the expense or to consider there should be further sale that you should generate on their production or not. So if you are the manufacturing production supporting document, it's very important for you. For financial institution, bank or microfinance, for example, the tax that the food focus is about the 4%, 14% withholding tax and the 10% VAT reverse charge. Because the bank, because in this industry will incur a significant transaction with the system and software, which is subject to this kind of tax. So for that particular industry, it is recommended to focus more on this kind of transactions.
Okay, thanks. And do you recommend companies should perform internal tax health checks or reviews? And if so, how often should they do that?
I would suggest split that for newly registered entity and the existing entity. For the newly established entities, I suggest that we can conduct a review just 1 month or 3 months for that particular year to see whether any potential tax exposure incur or not. If yes, we can extend the scope of work to review it for the whole year. And after that, we can have a regular review every 3 or 6 months for the newly established entity. For the existing entity, it depends on their capability of the accounting and finance team. Based on my experience, some big companies have very strong account team and finance team. Then I think it is not necessary to conduct a health check.
Okay, but in the situation where you have one company looking to buy another company in Cambodia, then the company that acquires the existing company, they then become liable for any back taxes, etc., that the company they're buying owes. That's right, isn't it? And then, so if that is the case, a company's better off in being safe. Are they better off in acquiring assets from companies rather than actually acquiring the shares in a company?
You are. I'm about to say acquiring the asset options. Yes, there is 2 options for acquiring the company normally. So either you can acquire through share acquisition. If you proceed with this option, meaning that you take all the asset and liability together with the tax liability as well. So if you want to minimize their potential future tax exposure, so normally the buyer will require the seller to conduct a final audit up to the latest year if possible. Then it will already settle the prior period tax liability. But sometimes it is the time-consuming process, so they cannot wait for that result. So the alternative option is that you can buy an asset rather than buy a share. You just buy the business, and then you don't liable for any tax liability in the future.
Yeah, and if the seller is adamant that they need to sell the shares, not the assets, well then the company could get a tax due diligence report done on the company they're looking to acquire. So get a firm like a client, for example, to do a complete tax due diligence on the company that is to be acquired.
Yes, correct. In that due diligence report, they will highlight the red flags that the buyer should be aware of, and that is the input for discussion with the seller on the selling price as well. If there is huge amount, sometimes the holdback amount will be much. Let's say as long as you settle tax liability, then that whole amount will be released. Otherwise, we will keep that for settle the future tax liability.
Okay. And with changes in tax regulations and also the issuing of PRACA in relation to tax, there's often grey areas or interpretive areas of the law. So the GDT may have one view of the law, and advisors or the company may have a different view. How generally should those differing views be addressed?
Okay, firstly, make sure that you can update that there is an update regulation. Secondly, is sometimes some tax agent like a client, they have a newsletter issue every month. So you can base on that to understand more about the interpretation and the meaning of their regulation. But still, you cannot conclude whether it's correct or not. then you can reach out to the specialists like us, not marketing, but it is the case that you have to consult with the expertise about that regulation. But in reality, expertise sometimes cannot confirm their position as well on certain tax item or provision. If it is the case, the last option is we draft a ruling request to the GDT to confirm the position. Before, yes, we acknowledge that sometimes it's time consuming that the GDT will respond your request or sometimes not respond at all. But recently, we have noticed that the GDT is actively in responding to the taxpayer request, especially for the ruling. Yeah.
Okay. And how long does the GDT normally take to respond to a ruling request?
It depends on the item that you have requested. It is not really fair and it does not impact to the other taxpayer as a general. They may respond quickly. For example, sometimes that response or confirmation will impact their treatment as well. So they are collecting tax. If they confirm the position, it impacts their future collection as well. So if it's the case, it is a bit time consuming. They have to internally discuss within the legal department as well how to respond to that particular transaction.
And do the GDT ever make those rulings public, or is it just a private matter between the taxpayer who has asked the question and the GDT?
I have never seen the GDT publish the ruling required by the taxpayer, but sometimes the issue we consider a ruling as well, the manual of meeting between the private sector and the GDT. For example, when they issue a new regulation like Prakat tax on profit, then there's a lot of items subject to clarification. Then the private sector and the GDT discuss about that together with the tax treatment. So after the meeting, they issue the manual of meeting public. Then to me, it is considered a ruling as well, but it is not the request from particular taxpayer.
Okay, thank you. And another question here, does the GDT have any plans to include the reverse charge output tax on the monthly return instead of having a separate declaration?
Up to now, we have not yet get any update on this question.
Okay, thanks. So just to wrap things up, this webinar, there are a couple of questions in the chat that are a little more detailed. That one by Stephen and one by 007 is the name in the chat. We'll answer those questions for you later because they're a little more detailed than we can answer at the moment. But Pal, just one closing question for you. If you were advising a new international company entering Cambodia today, what advice would you give them to get right in the first 12 months?
I suggest that make sure you properly file all the monthly tax return and annual tax return by deadlines, and to avoid any amendment of the tax return. In doing so is to avoid the tax audit on your first year. If I said you missed the deadline, for example, and you amend a few tax return, it is the factor that I believe the GDT will conduct an audit next year.
Okay, and if you are a new international company coming into the market, when can you apply for exemption from minimum tax? Do you have to have a track record in Cambodia before you can apply for an exemption from minimum tax?
Technically, there is no restriction of the time that you can apply for that minimum tax exemption. But based on our experience for the newly set up company, it's quite tough to obtain that approval. The argument from the GDT is that, okay, we don't have past record of your company and you don't have the audit report, for example. This is the reason why we cannot issue the approval letter. But this argument is technically incorrect because in the regulation it clearly states that if we meet the condition, then we can apply for the minimum tax exemption, which we call proper accounting record enterprise.
Okay, thanks, Pal. So that brings us to the end of the webinar. I don't see any more questions on the chat. Of course, the annual tax on income return is due by 31 March. So that's the end of this month. If any of you need assistance with preparing and lodging your tax on income return for 2025, we stand ready to assist. So please get in touch with us. But thank you all for participating in the webinar. We hope you found it informative. And we will be having other webinars in the months to come on other topics, which we hope you will find interesting. So thanks, everyone.